Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Peterson. So today I have with us one of our newer Verivest verified members. As you know, my day job over at Verivest, Matt Belcher with CalTier. So we're super excited to have him. Thanks for joining us today, Matt.
Hey, Lance. Thanks so much for having me.
Yeah. So before we hit record, we were talking Ted Lasso, the phenomenon that is Ted Lasso. So if you don't have Apple TV, you got to go check that out. It's brilliant. So Matt, why don't you share a bit with us about how you kind of got into commercial real estate? And, I'm super curious to sort of learn more about what led you guys to forming CalTier and those things. But really, I'd like to start with what was your first foray into real estate? What kind of, drug you into this space and got you passionate about it?
Right. It's always a great question, right? And on that Ted Lasso thing, I love how we were just talking about how he's kind of molded British and American cultural differences, and he's done it in a brilliant way. So yeah, like you said, if you haven't gone and watched it, it's worth going to see. So obviously I'm from the UK. I've been in the US now, it's coming on my 11th year. Actually in October will be my 11th year. I'm by trade, I'm a management consultant. I've had a few businesses that I've run in the UK. I used to work for a lot of the large management consulting firms there. I traveled around Europe selling software and services and doing a lot of mergers and acquisitions, mainly actually for oil and gas. I spent a lot of time in Norway and those kind of and Holland with Shell and Statoil and those types of companies. So I wasn't really in real estate back then, other than owning my own real estate. So obviously, I've owned actually bought what we would call in the UK a flat, a condo in the UK very early on, probably when I was 21, 22. And never really thought much about it. Just very lucky, bought in the right places in London. I've had a couple of them that doubled and tripled in value, and there was nothing intelligent about it. It was purely buying at the right time, holding for 5-10 years, making some renovations on them just because I wanted to, and said, oh, I'm really good at this, right? I know how to do real estate. Then overextended and bought, some other houses that didn't do so well, and suddenly got slapped and realized, the real estate game is not just a case of buying low, holding. I mean, there's a lot more to it. And so I don't really think much more about it. And then I moved to the US and did the same thing here. My wife and I at the time, we bought a house. We bought in 2010. It was a short sale. It was cash only. It's gone up in value. It's tripled in value. And even while we had it, we thought that we were really clever because it almost doubled at that time. And it was around about that time I got involved in consulting for large-scale commercial real estate. I started working with some firms, and I got involved in this, the multifamily acquisition business. And really, that's not something that really exists in the UK necessarily. It's actually changing. There's a lot of movement towards that, but the way it's so established here, it's nothing like it in the UK. So that's kind of where I dovetailed in. And, again, I thought to myself, well, I know all about this industry because I've made some money on some condos,
Right.
But very quickly learned that it is not the same thing. And just because it's real estate, there's nuances within each section of real estate. So that's really how it began my initial journey here in the US into commercial real estate.
Yeah. And then you guys, because there's how many of you partners? You got 3 or 4 partners, right?
So I think we have 4 listed right now, but we have another 2 or 3 coming on.
Yeah.
These are institutional grade partners. And that's really where CalTier began, because I personally wanted to invest into some of these. We looked at retail, we looked at office. This is all pre-COVID, right? So that's a whole different landscape today. But back then we were looking at everything, and we really liked my partners and I liked the multifamily space, and really quickly realized that, you have to have a fairly significant amount of wealth on hand to be able to participate in some of the better stuff. So for the vast majority of people, they don't have the ability to do 150, 200, 300, 400,000 at a time and have it parked for the life cycle of the business plan of that asset. So let's say a 5-year business plan.
Right.
And I certainly didn't, to be honest, Lance. That's where CalTier came from, because I said, man, if we're having difficulty in participating in this type of asset class, like there must be more people who are having those difficulties. A lot of the better stuff, you've really got like a 30 to 40 day window. If you're the general partner that's doing the acquisition, if you're the acquisition partner, from basically going to look at the asset to close is a 45-day period, especially now. I mean, now it's even more aggressive, right? You don't even get invited to the party unless you've got a rich history of deals that you've put together.
Yep. Yeah, definitely. Yeah, it's gotten super, super competitive. And you're right. I mean, the barrier to entry is high, and it's been higher in the past. And I think that's what's interesting. And I like what you guys are doing at CalTier. It's the recognition that that's the case. But it doesn't have to be that way, right? Like we can, because I'm about accessibility. I'm not about, I mean, as much as I'd like to see it, of course, I want democratization of, real estate. I mean, I'm all for that. I mean, democracy is great, right? Like, but it's sort of like, one thing at a time. To me, it's access. How can we give people access to something is sort of like the starting point. And I think that with the change in the Jobs Act, which led to advertised listing, which led to sort of the change in the Reg A offering, which was little used to not used with what we call Reg A plus.
Right.
You guys have went through the beating of having your fund become a Reg A plus offering, which allows then non-accredited investors to participate. And I believe your minimum is as little as $500. Is that right? Like for as little as $500, you can invest into the fund, right?
You're totally right. Yeah. So we're utilizing the Regulation A plus. So our fund is qualified by the SEC. So our offering circular is SEC qualified, and we are raising. Actually, they just changed it. It's now going to 75 million, but currently we're at 50. In November, we will up it to 75 for next year. We do. We allow anybody to come in over the age of 18, as long as they don't have criminal record. They clean background check. They can come in for $500. The reality of the situation, and this is something we're really realizing, Lance, is that the most people that come in are actually time poor. Sure, most of them can't do $250,000 10 times in the year, right?
Right.
So they're looking to diversify their stock portfolio, maybe hedge against some of the ups and downs in their stock portfolio. And there's been some great articles recently about is the 60-40 way of investing dead? And I think a lot of financial critics would say it is, because you can't get the yield now on bonds and those types of things. So everybody's now looking at, how do I get, you've got great companies like Republic, platforms like Republic, Start Engine, you name it, right? They're all out there. And that's what we're realizing is the most of our clients, our investors, are actually, they may be high earners, but they're time poor, but they're not quite at that point where they can just dump 250 grand into 10 different investments and hope that they're going to make money. So they might start with 500. We have people that come in at 500. They do 500 every month. We have people that dip their toe in at 500, and then they come back and say, we really like what you're doing. I'm going to do 5. I'm going to do another 10. I'm going to do another 15. So actually our average investment is growing all the time.
It's great.
In this particular fund, what they like is that we have like a yield and an upside. So it's an income fund where you actually buy shares in the fund. And as the fund grows in size, so too can the value of those shares. So they're getting a bit of best of both worlds.
Yeah, that's right. And that's it's great about most, multifamily. I mean, even stuff that's considered core or core plus. I mean, and this obviously has something to do with just the fact that there's housing short. Supply and demand sort of is in our favor here in terms of getting growth even out of stabilized assets. So for you guys, as you construct the portfolio, where are you looking to invest? Do you have sort of a geographic kind of footprint that you're looking to acquire in, or what does that look like?
Yeah, that's actually a big question, isn't it? COVID has moved that around a little bit. CBRE have a great report out that says that we have a 3 million shortfall of new multifamily units over the next 10 years. So that's not renovating the existing, that's a new shortfall. That's the demand, the new demand. And then I think in multifamily news, Fannie and Freddie came out and said there'll be about $400 billion of acquisitions this year in 2021. So where we were looking a couple of years ago is a little different now. Basically, our target is the Smile States, is South, Southwest. We have some stuff in Texas. We're looking at those markets all the time. You mentioned our partners. That's probably one of our differentiators, is that we work. So through our portfolio, we do make direct investments ourselves, but we work with some of the biggest nationally recognized, or certainly I'd say regionally recognized companies who do, a couple of them do several $1 billion worth of real estate acquisitions, development every year. So we kind of rely on them a lot. We go to their investor conferences. We're a partner of theirs. We go to we talk to their acquisitions teams. We say, like, what are you invested in? Where are you looking over the next couple of years? Right now, our portfolio includes assets in Utah. We actually have some multifamily, and we consider this multifamily, but it's a great student housing development right by BYU. We've got something in Texas. We've got something Arizona, and that's kind of our spread. Where we go next, this COVID market is interesting. We're constantly polling our partners to ask them where they think the next good place to go. Just to add to that, Lance, the good thing about the A, B, C, D, the kind of where we enter into, we don't have to worry. I don't want to be misquoted here. If we were doing A class stuff, you have to really be worried about where you're going, right? Because you really do. But we're doing renovation, so we're doing value add, and you can be a little bit more flexible of the general economics as long as that's central place there. Because a big box store or a big firm coming in, you can already see, okay, every single other asset here is 90% occupied, 1995. This one over here is 1970s. It needs renovation. There's a huge delta compared to the rents on this one as opposed to the one down the street. So you have a little bit more flexibility. Of course, the game in that is to make sure you get your CapEx right, because the worst thing you want to do is acquire that asset and then mess up the renovations.
It's a lot of execution risk. So that's where sort of the those with strong track records that know how to execute is sort of how you can mitigate that. But yeah, like you said, I mean, that's what sometimes you buy this brand new Class A thing, you think, well, there's no risk there. But if it's not in the right market, you could suddenly have that thing vacate quickly, and there's nothing coming behind it, right? Or the rents just soften significantly, and you're going backwards because you bought in at this, at the NOI that was there, and now all of a sudden that's not there anymore, and your values, and you're gonna hold on to it for 10 years to get anything out of it.
Absolutely. Imagine if the big tech company down the road that's anchoring a third of your tenants, right? You're paying software engineers, and San Diego, right? A 2-bedroom apartment here, less than 1,000 square feet. I mean, you're going to pay $3,000 for that. Jeez. And if the technology company down the road is anchoring a lot of those people and driving a lot of business, and they cut back, like you say, what do? There isn't a lot of people out there just bumping around that can pay $3,000 for that type of asset. So we go into that workforce housing. We go into that value add. Sometimes it's soft. Sometimes it's a repaint and a repurpose. Sometimes it's super deep. I think you nailed it though. That's probably one of the value adds that we provide is we're working with class leading localized companies that do that and have a really big track record. So when we invest from the fund fractionally into their investments, we're doing a ton of due diligence on that company before we even engage with them. So I want to know, my team want to know, how many have you done over the last 5 years? What's your success rate? Did you have to go and do capital calls to the investors because you made a mistake? COVID's been really crazy, right? Because of the cost of material. So, a lot of companies have been raising significant capex to pay for the heightened, the inflated
High costs,
cost
materials. Yeah, exactly. Yeah, no, it is. It's been super interesting. Nothing, certainly wouldn't have predicted how this whole thing went down. I mean, it continues to go up and up and up, and it's very interesting. But you do see the power of supply and demand. I mean, this is just an absolute case study in supply and demand in every way imaginable. Right? When it comes to housing, as we've said, millions of units short. There's just not enough housing in the places that it needs to be. And then you look at all these supplies. I mean, from food to materials to lumber, whatever it is. It's just that's what COVID did. It's just the music stopped, and it created it's just unprecedented. So it's been interesting. But yeah, I mean, at the end of the day, it does come down to, and obviously at Verivest, we're all about that. It's just like it all starts with the operators. Like it starts with the sponsors. It's who are the people behind it. You really, the people drive things. I mean, as me, running a company or whatever, I mean, it doesn't matter how great my ideas are or whatever I'm doing. It's like, it's who's going to put the shoe leather on it. We hire, and I think Jim Collins taught us all that in Good to Great. I mean, you look at these companies, one's an outperformer and the others, going backwards. And, sure enough, it's the leaders and the vision and those sorts of things that make a difference. So, and I think people are realizing this now too, is just that, okay, real estate, we all know it's a local business. And the best of class operators are going to do business in a certain area. And to have other people though, that can, like yourselves, who can go and vet the operators, the sponsors and the project, and then allocate capital into those projects. That's how you can create the diversity. It's not to say you can't go invest directly with the sponsor. Certainly you can do that, but to your point, the net worth requirement in order to do that is, I mean, we're talking on one extreme end with what you guys are doing, as little as $500, but even somebody who's got a net worth of, I mean, shoot, $5 million, I mean, which is a lot of money, but it's not that much money. And then you say, okay, I mean, 60-40 is sort of dead, but even then, like a reasonable allocation to real estate, 20%, I mean, 25, which is probably viewed as pretty aggressive from some people's standpoint, that number shrinks, right? So now you look at, you've got a lot of eggs in one basket, even making a couple $50,000, $100,000 investments. So for me, that's what I'm all about too, is like we've talked about, like access, but it's also just about, okay, you have this portfolio. So we need to create ways where that access allows you to create diversification, to your point. And I think that's what's great about what you guys are doing. My curiosity with what you guys have been doing, when you're going into a given deal, is it usually being syndicated itself, or is it like a joint venture, or and how big are your allocations into these of the equity stack, or do you guys even go like in a pref equity? Maybe explain a little bit about the cap stack and what your philosophy is on portfolio construction and that.
Yeah, no, absolutely. And I do want to say we love, we were all about this when we saw what you were doing with your company, because, this whole, like you said, the democratization of wealth and these platforms like us and others, it's just going to get bigger and bigger. So to have, a company like yours that are providing this, overarching due diligence, I mean, we love it. We're all about it. So that's why I'm very, very happy to be here and very happy to be on the platform. I think it's a brilliant idea. Yeah, so we have one fund right now. We're about to launch our REIT, hopefully by the end of the year. That's in legal process right now. It takes it doesn't take a 2-minute job.
Yeah.
And it costs a bit of money. So our current fund works in this way. We're basically allocating about 30 to 40% of the fund gets distributed into what we call these fractional partner investments. So we'll go to a large operator, and we've already got that network, and we've got 4 or 5 already. We're establishing more as we go, and we're saying to them, look, we're collating money in this fund. We're the general partner. We're distributing it. We'd like to carve out a certain amount with you. If it hits this kind of set profile, it needs to be a certain IRR, a certain equity cash return. We're obviously looking for multifamily. We're looking for value add, cap rates, so on and so forth. So our allocation of our fund is around about that 30-40 for those types, and then we're doing smaller. So sometimes they're big, sometimes they're $20-30 million investments that we're fractionally coming into as an LP investor. Funnily enough, you mentioned people with their allocation. We have a guy who came into our fund, and one of the investments in the fund, he also is invested in it, I believe, separately. So he knows that company, he put some money in it, then he came into our fund, and I think that's how he found us. He said, I noticed that you'd invested in it. I love your fund idea. I want to just put some in there because you're spreading things. So the other, let's say 60%, we actually keep some of that cash in hand because we're a fund, so we have to have some liquidity. The rest of it goes into direct acquisitions, where we'll be the general partner in those. So the fractional investments, typically with the LP, we could be co-GP, but for right now we're the LP. And then in the direct investments, we're always going to be the GP or co-GP if someone wants to come in with us. So we have better returns. So you have bigger returns on the GP side, but you're spreading a lot of the risk with the LP investment.
And does that also too, like for the security side, does that allow you to maintain your status as like the 3C5? Is that part of it? Like that it just happens?
It's exactly.
At the 60%. Yeah, exactly.
Yeah,
we've got a lot of clients that are doing that. Yeah, that's right. You've got to, so that those LP interests are securities, so you have to maintain your real estate interests at least 60%. Which is that's in this business. I mean, like it's not in my opinion, it's not heavily regulated, but navigating the regulatory regime is, I mean, as you guys know, you tripped even more of it with the Reg A, right? Like, it's pretty wild, right? It's really wild to sort of navigate it. Like the things that one think hey, I just want to go do this. Like, it's usually like, no, you can't do that. Right. Like there's some limitation, it's like,
it's not as plain. You can see the ocean, but there's wind and there's waves and there's a whole load of stuff. We're actually, part of when you have a Reg A fund, a Regulation A fund, you can never really give projections. I can't really say, this is the performance we're going to do. There's a lot of regulations around that. But one thing we are doing as a company is we're registering. We're in the process right now of actually registering as an RAA for that very reason, because we're establishing our REIT. And the other big piece that we do is a lot of our clients come in through their self-directed IRA, through other custodian partners that we have. And as an RAA, we want to be able to open those up for our clients. So that's something on our roadmap, basically.
Yeah, no, it makes sense. So how about maybe tell us a little bit more about the rest of the team and your partners and sort of what, because you're all based down in San Diego, right?
95. Okay. No, yeah, we have some people that do underwriting and some other things. They're remote. The majority of the team is here. So
on the acquisition side, so like when you guys are going direct, then are you sticking closer? Like, I mean, I used the Smile States, but is that broad too? I mean, like, is there certain is that a tighter box for the stuff that you guys are buying? And maybe talk a little bit about, for the assets that you guys are the GPs on, asset management or property management, and how how you go about handling those things.
Right. So I mean, we're in a massive growth stage right now. I mean, April was really, we moved platforms in April. We've seen exponential growth in our fund, in what we're investing into. So yeah, the fractional investments, we're way more comfortable because we're coming in as an LP. So, we go down to Texas, we could go, much further afield.
Yeah.
With the direct investments, we're actually looking, we want to make sure it's kind of an hour's flight for us.
Okay.
And we have one of our partners, one of my co-founders, Parker Smith. I mean, I'm more on the operational side. Parker focuses on really running more of the real estate side. So he has a couple of folks in his team directly underwriting and acquisitions. And then we have actually a partner company or a couple of partner companies we work with where we bring them in because they have very significant experience. So as we build out our direct investments, we're actually in a fundraise right now, Lance, to build out our team. So we'll probably bring in that skill set. Right now we're working with, we're basically hiring in a partner to assist us with that. But as we grow, we'll definitely be bolstering up that team.
Yeah, that makes sense. Yeah, I think that's the thing too, that from an investor's perspective is just realizing, there's so many disciplines that it takes inside to really run a real estate investment firm. And, it's funny because a lot of investors, and once again, I think these are things that you need to look at, but they sort of push back on the fees, like a management fee or, asset management fee or whatever, like, oh man, you're going to charge them 2% or 2.5% or whatever. But it really, in people, I say, it's like, it's what keeps lights on, but it's like, it doesn't, it barely keeps lights on, and it certainly doesn't feed all the people. And I think that's the hardest part. Right. And certainly one of the things that at Verivest, we're very cognizant of and trying to help solve for, right, is allow people to build their teams where they just have to have those who really, it's core competencies only, and not, and really ability to outsource some of those other functions that just, that aren't core, right? That don't move
right.
Because it's all back and loaded. I mean, you're not getting rich, and it's not a get rich overnight business. Certainly.
It's really not. And look at some of the underwriting services that are out there now, right? There's software out there hosted, software as a service. There's some great ones out there, taking nothing away. I mean, we have guys that underwrite for us, but you go to some of those services, I mean, they're underwriting hundreds of deals a week.
Yeah.
And so you can pay them to underwrite your deal. And at first you think, well, then they're not really bought in, but they do a super job. So there is a lot of skills, as you say, that you can now outsource. I think there's some things you always want to keep in-house, but there's definitely some things that you can outsource.
Yeah, exactly. It's things like that. It's those initial scrubs and putting the pro forma together, whatever, and then it's just then the ability to go, because it's so labor and time intensive. You can't build a pipeline that has any. Yeah, I mean, we've lived it. We've executed similar strategy to you guys. Like, you go build partners and you LPs and you co-GPs, and it's. I mean, I'll never forget it. I mean, it was the hardest 3 or 4 years,
right.
for us back in. I mean, it's similar when you kind of got into it. I mean, it was 2011, 12, 13, 14, and 15. It's just brutal, man. Like,
right.
so hard. But the good news is, if you stick with it, right, it's 10 years down the road. It's very rewarding. It's rewarding for the investors, and it's rewarding for the investment firm for kind of sticking with it. But it's certainly not for the faint of heart. That's it's like you right. Got to have some grit to you.
And you do. That is true.
Yeah. So for you then, coming from your position, I mean, what is the one thing that you share with investors that are thinking about allocating as the important things to sort of think about before they make an investment? Like, what are your sort of key tenets when, from the passive investor side, underwriting an opportunity, especially since you guys do quite a bit of that? I mean, at least 40% of your portfolio is kind of in that seat.
Yep. Yeah, it's a great question. For me, it's use of funds first. I mean, you can zero out and look at the location and everything, but if you dived in and said, well, I really like something in a particular area. So a lot of people were hot on Arizona for a long time, right? And you get people going back and forth saying, well, Arizona's done. There's not a lot of value add left in there. It depends on the use of funds. So if you're an investor looking at an opportunity, and we all know there's tons of them out there, you really want to understand, what is my money being put towards, right? Is it the AC, what's the AC fee look like? They're charging a 6, 8, 12 AC fee, which sometimes you see out there,
Yeah.
right? Is the general partner making money kind of with me along the way? I mean, almost pari passu, right? So in effect, so do they make money because the asset makes money, or are they making money from raising money and acquiring this thing? What does the CapEx look like for the asset? And then I think you can zero out to, okay, what is the local demographics? What's really driving this? I mean, if somebody says, well, there's no multifamily for 20 miles from here, so that's why this one's going to be good. You say, well, there's a reason why there's no other multifamilies nearby.
Exactly.
Right? There's a reason. And it may well be you've got this niche little asset that is fantastically placed and nobody else has thought about it. But the reality is that's probably not a reality. What you really want to see is, what are the other operators doing around you? What is their occupancy looking like? And are they at 70%? Are they brand new? Are they really old as well?
Yeah.
There's so many things that go into it. But for me, when I, Parker, my partner, and Travis, they look at things differently. Our underwriter looks at things differently. But when I get that stuff put across my desk, I always, for me, it's always use of funds first, because I just want to know. You can tell a lot by how the operator thinks about how the money's being used, basically.
I agree. I'm glad. It's funny you said that, because that's what I do as well. I go right to the use of funds, and I just scour the operating agreement for where the fees are. Like, I was reading one a few weeks ago. This was for a fund. It was for a self-storage / mobile home park fund or something. But it was interesting. A little section there in the operating agreement said, refinance proceeds, will go 70% to the members, and 30, basically said 70% to the members, 30% to the manager, the general partner. And I read it again, and I'm like, is that saying what I think that says? So it's saying that you refinance a property, and the cash out that comes back, because that it literally is not going to run through the waterfall. It's just going to be whatever we get, we're going to just take 30% of it. So it's basically a 30% refinance fee. Right. That's not what it says, but that's what it says.
Right. Absolutely.
You know what I mean? Like that little thing. And I'm going, how many people just gloss right over that? Like
95%.
Yeah,
right?
Because they're going and looking at the other fee sections. So it's just, it really is. I mean, there's the PPM and whatever, but I mean, to me, it's like, it's the operating agreement. And unfortunately, like many things in life, right? Sometimes it's what it doesn't say. And I think that's other level stuff when it comes to identifying what's not there. Isn't it like in the Jewish rabbis, right? It's like even the spaces in between the letters had meaning. Something like that. It's like mind blown. But so it's things like that, and that's what I mean. Like it can be overwhelming at times, especially real estate guys. And I'm sure you know this. I was an outsider as well. I came from a different thing. I'm like, you guys speak this jargon that
they do.
You speak a different language, and you wonder why no one wants to hang out with you unless they're another real estate guy. It's because
that's
what the hell
so
are you
true.
talking about? Yeah, I mean, I don't even understand a word you're saying. And so
they're super bright people, right? They just have. You start talking about NOI and cap rates, and then you start talking about how that blends, and then it goes on and on and on, and it's a very confusing, locked out business, actually, which is what we're trying to solve. We're trying to open the doors and give access to people who are time poor and would like to participate into some of these deals.
Yeah, that's right. Yep. I hear you there.
Yeah.
Cool, man. I'm glad we're able to catch up and do this. So where can people learn more about CalTier and get involved? Certainly, they've made the bar as low as it possibly can be. So you got
we tried.
bucks and you kind of know what you're doing a little bit. it's a great place to sort of start. So where can they learn more about CalTier?
Yeah, thanks, Lon. So you can get us at CalTierRealtyFund.com. So CalTier fund.com. That's our Regulation A fund. I encourage everyone, to your exact point, I encourage everybody to click on the button that says offering circular. Take some time, read our offering circular. We don't hide from anything in that. My support staff are great. They'll answer any questions. And I think that, we've got videos on there, we've got FAQs, they're really cool, they really help. But if you really want to dig into it, read the offering circular. That's filed with the SEC. That is basically how we operate the business.
Yep, I've read it. It's good. It may make,
oh, you have? Okay, cool.
It make you a bit drowsy. Oh, yeah, I've read it.
Yeah, it's not the most exciting document in
yeah, so I'm a nerd. Like as I said, you probably think I tend to actually read those things. Yeah, and enjoy it. That's what happens to you if you're in the business long enough. Then you actually read that. Right. You like it. Like, I got my hands on another one. I got to read it. So if you listen to this podcast too long, maybe you'll suffer from that as well. But it is a good sleep aid. So thank you so much for your time. Appreciated having you on. Glad we're able to connect. If I'm ever down in San Diego, definitely will look you up. If you're you're more than welcome. Thank you so much, Matt.
Thanks, Lance. Really appreciate your time, and thanks for having me on.
Yep.